The state of the music business.
The amount of self-releasing artists grew dramatically in 2024. It's up to 8.2 million. So what that means is more artists are making on average less money. That is only going to get worse. So even though it's the time where it's become most difficult to monetize, the time where streaming had essentially put up a big sign on its door saying, long tail, you're not welcome here, more people than ever now want to make music. Maybe as little as 3 to 5 years in the future. It's with all of these funds that are in acquiring catalogues, they are fundamentally music publishers. So at what stage do they start becoming really significant constituents, starting to be the ones who shape the lobbying efforts?
This is a great point that I haven't heard many other people talk about, predicting BlackRock or one of these companies to be dictating the terms for what the future of publishing may look like. You may have predicted the M&A future of the industry for the next couple of years. If you had to guess what the big theme or what one of the big takeaways would be from next year's report, what would you say?
Indie label revolution. And when I say revolution, I'm talking about pitchforks and torches rather than transformation.
We're going to talk about the 2024 global recorded music business. In 2024, the business generated $36.2 billion. That's a 6.5% growth from the year before that. That may not be as high as some of those pandemic numbers, but it's still pretty solid. But where things get really interesting is when you dig into that data. You start looking at what that growth looks like across different countries. You look at it comparing different formats, like streaming and vinyl. You also look at it when you compare the major record labels to the non-major labels, to the self-releasing DIY artists. And then you also compare it to the streaming services themselves. And there are stories upon stories upon stories to dig into there. And that's what we're going to talk about in this episode. To join me, we have Mark Mulligan. He's the CEO and founder of MIDiA Research, and by far one of the most insightful people that I've spoken to in the industry. This is a fun conversation, and if you want to know where the business is going, this episode is a must listen. So hope you enjoy. Let's dive in. All right, today we're going to talk about the state of the music business. We're joined by the founder and CEO of MIDiA Research, Mark Mulligan. First time on the show. Welcome.
Hey, thanks for having me. Yeah, you've been doing great work. I'm really looking forward to this.
Likewise. But before we get into the report, I do want to talk about a bit of the release strategy, because you have your report come out that covers recorded music. There's, of course, the RIAA. There's the IFPI one as well. You think about rolling out in terms of, okay, let's make sure that we get our message out here and make sure that we're aligned just based on some of the other things that come out around this time frame.
So each of those organizations do really important things. But we've always felt that historically there's a good chunk of the market which hasn't been captured by the traditional trade associations. We think about things like the long tail of indie labels, artist direct, production libraries, expanded rights. There's a lot of bits which we've put a lot of attention into over the years to bring into the numbers, because we think when you put it in the round like that, you get a fairer, more accurate reflection of the state of the market. And that's fundamentally one of the key reasons we tried to get our numbers out there first, so people could see, okay, this is what it's like when you include all of this stuff, so that when the next numbers come out, understand that's a really precise measure of the market that comes out from the IFPI, huge amount of detail, but doesn't take everything into account that we do.
We realize that streaming is, of course, the biggest bucket that there is, but that bucket also isn't growing nearly as fast as it was before. This was the first year that what people saw coming actually came to life, and you called that out. I think that was one of the key themes from the report.
Yeah, it definitely is. We have been a bit like a stuck record, talking about the slowdown is coming, the slowdown is coming. Everybody knew that this was going to come. This is pretty much the year where it really kicked into play. And if anything, it's been a little surprising that a lot of big mature markets like the US have managed to sustain growth at such a good rate for a number of years. But it is also a very Western view of the market, and it's also a very revenue view of the market. We just today put out our subscriber market shares figures, and so that's measuring the number of monetized users rather than the amount of revenue. And that grew about twice as fast as record label streaming revenue grew. And so why is there a difference? Number one is a huge amount of this growth is coming outside of Europe and North America, what we call the global south. In subscriber terms, nearly 80% of all the new subscribers that were added in 2024 came from outside of Europe and North America. So they're lots of incredibly large populations there, so really strong growth potential. But of course, lower ARPU because the per capita GDP is lower, but also lower repertoire share for Western labels. So we're going to see this increasing divergence, I think, between what the revenue outlook for Western labels look like. And I'm very pointedly here not saying just the majors, because it does apply to the majority of Western labels, not all of them, but the majority of Western labels. And then, so we've got a really strong growth picture in streaming in terms of subscribers. The revenue is a bit different. And the last bit of the equation is in the mature markets. As said, markets like the US have grown a bit stronger for a bit longer than maybe was anticipated. Part of the reason is because there has been so much effort to go and get the last stragglers on board with really heavy use of things like free trials, etc. As a consequence, that has made revenue growth, even in the mature Western markets, grow more slowly than revenue has.
Right. And we saw this play out last year, the stock performance of the major record labels compared to the stock performance of Spotify. One of the big questions that analysts had was, okay, the two of these were going in lockstep for so many years. What was the difference? And the difference is exactly what you said there. The Western labels being much more centric, where subscribers are saturated, compared to the DSPs like Spotify growing in the global South and other places, especially if 80% of new subscribers are coming from that part of the world.
Yeah, 100%. That the streaming services, Spotify especially, have done a really good job of diversifying their revenues. And when we look at the bundling controversy, the US with publishers, etc., and then within a matter of months, we've got two major labels signing up bundling as established within the contracts. Why is that important? Streaming revenue growth will grow at a slightly different rate than streaming music revenue growth. And then you've got things like monetization of podcasts, etc. So none of these things on their own add up to, oh, here's a reason for the big difference. You put them all together and then you've got the start of a sea change.
And even thinking about some of the pushes from the Western record labels, specifically with the premium tiers, it feels like a product that is more designed to further extract more value from the Western world. And on one hand, I get it, right? If you're trying to grow a business, there's only two ways to really do it, right? You increase your prices or you increase the number of people that are paying you. One of those seems to have more of a ceiling than the other one does.
Yeah, but what makes it really challenging in music is, yes, there's a really strong argument that until recently, music wasn't keeping up with inflation in terms of subscription pricing. The huge amount of value you get for your subscription in terms of the amount of music that's in there and unlimited listening. But what is really the value of music? The value of music, monetarily speaking, is fundamentally what people will pay for it. It's not what people think it is worth, it is what people will pay for it. That's just basic market economics. And so at the moment, you can see there is a really different amount of money that people spend on video versus what they spend on music. Does that mean that music is undervalued? We'll find out when we get to the point where people stop paying more for streaming. And music does not operate in a vacuum. If you're a music superfan, the exact target for super premium, we're probably spending a lot of money on gigs and merchandise and a whole range of high-end sort of artist-branded stuff that the record labels are bringing to market now. So yes, the future is absolutely increasing pricing. It is absolutely, super premium is going to be really important. But the likelihood is there is only so much distance we can go with the average subscriber, and there's only so many super fans who are willing to pay for a super premium service. And even then, do they end up spending more on music overall, or do they spend less on merchandise and live in order to get super premium?
Right. I agree with the breakdown there. I remember reading on one of the earnings calls from Spotify after they had increased prices. Someone had made a comment about being pleasantly surprised that increasing the price didn't result in churn in that type of way. And yeah. I think a lot of us internally in the business were like, yeah, we could have told you that going from $9.99 to $10.99 probably wouldn't have broke the bank for that particular market that you're...
Just one thing I'd add on that, though, is it's not really churn you need to worry so much about. It's acquisition rates. It's the people who haven't yet subscribed, particularly in markets which are pretty developed. Either music doesn't matter as much to them, and or they don't have as much disposable income or willingness to pay. So they're the ones who it's already more difficult to get on board. If the price keeps going up, then the rate at which you can gain new subscribers is the thing that is most at risk. Now, in the market like the US, not going to be a huge problem because a majority of new subscribers are already there. But you look at a market like France or Germany, which has still got a lot of growth left in them yet, then you might be facing, not at this round of price increases, but maybe the next. That's where we might see acquisition rates beginning to get dented.
That's a good call out. People probably think of France and Germany as being more mature markets. And while that's true, not every country in Europe is the same, right? Yeah. Like you can't just put them in the same bucket as UK or Sweden, for instance.
Yeah. And by the way, France is a hugely underperforming market when it comes to subscriptions. It is just so far behind in penetration terms compared to Germany. And so the plus side is France has got loads of upside in it. The downside is if price increases go up at the same rate in France as they do in other markets, then it might be hard to convert that potential.
One thing that I do want to talk to you about is expanded rights specifically. You've also written about this when you've talked about the next generation of streaming and where things look like. So talk a little bit about what's included in that and where things could go moving forward.
Yeah, so we started including expanded rights for the first time last year. And the reason we had it's just getting too big and meaningful not to include. So in 2024, about 4 billion of that was expanded rights. 13% of the market is now coming from expanded rights. That's where you get merchandise revenues. If labels have got artists on expanded rights deals, then they might have a share of live revenue in there. They might have a branding and sponsorship agency where they go and find branding and sponsorship opportunities for their artists. If you're one of the Korean labels, you might be making cartoons and anime and a whole bunch of other things that you can do with the artist's image and likeness. So it really is all the things which we would associate with being the fandom side of music. The streaming services were never really built for fandom in the West. I keep saying in the West because Chinese streaming services are totally and utterly different. They are built as fandom platforms. And that's why we've seen people want to express themselves as music fans. They're going and buying merch. They're going to the concerts. They're doing all this stuff on social. And that's why expanded rights is so important because it represents a way in which labels can start to participate in some of that revenue. I'm emphasizing start because so many labels do not have many of these rights for so many of their artists. And in this sort of era of empowered artists where artists are saying, I want to keep hold of my rights, I just want to do a distribution deal. That is the exact opposite of what labels need if they want to go and build expanded rights.
Because this was the one question that I did have when I talk to artist managers or talk to artists themselves. They see this as their thing. They are focusing on pushing their e-commerce. I think about a Travis Scott or Tyler, the Creator, any of those. They built standalone companies to have a lot of this. If the biggest artists in the world have their own entities to sell their own expanded rights outside of the traditional record label system, what does that growth look like for them?
To explain that, I'd rewind 10 years ago and then 5 years ago. If you were on a major, you were getting maybe a 20 or so % deal, you were signing everything away forever. And fast forward 5 years on, when we've had the rise of artist distribution platforms, etc., more artists were looking for JVs or distribution, wanted to retain ownership of the rights, etc. And even though that's pushing in the other direction, pushing away from artists wanting to give more to the labels, what the labels had to do was become much more collaborative, and they had to think almost more like an agency than as a pure business partner. And I think that now is what labels are increasingly having to do. It's got to be a genuine value exchange. It's got to be, sure, you can go and build your own D2C if you want to, but you're going to have to probably hire people to do it, and that's a chunk of money. You're not going to have the expertise yet in order to know how to build an audience and how you run your email campaigns and all the really boring but really important parts of building a fan strategy. But we've got all of this in-house. We've got capabilities, big data, all of the learnings that we've learned from working with other artists, and so we will give you the chance to be able to deliver far more value from your fans than if you do it on your own. Does that argument work with the big established artists? Probably not. But for a younger generation of newer artists coming through, then that's probably where the argument can carry more weight. And of course, if you're a Korean label, then, many of the artists don't really have any choice in the matter anyway.
It's a similar dynamic to how they've treated the record label deals in general, right?
Yeah.
Let's be a partner to add value, and the superstar artists are still partnering with labels. The economics look very different today, but they're doing it because of all the things that you mentioned. The other thing that stuck out to me about the report was two things. So one, you separate independent music, looking at it with non-major labels, but then also looking at it with artist direct. I think oftentimes people can just loop them together and say the rise of independent music, which is true, but we can get a bit more nuanced. And one of the things that you had pointed out is that the non-major record labels actually grew at a faster rate in 2024 compared to artists direct, uploading their music directly, one of the distribution services. When people think about independent music growing, they may think it's more the latter, not necessarily the former. But I think there's a few different takeaways about why that is and what independence really means.
Yeah, so I'm going to take those in the two separate parts because they're two really different stories. Just in the same way when we were talking about streaming earlier on, there's a really different picture if you look at it in value terms versus volume terms, revenue versus subscribers. For artists direct, the same applies. So the value terms, they got to $2 billion. It's a really big, sizable chunk of the music market. But until 2023, every single year, the artist direct revenue growth was far bigger than anyone. And in 24, the revenue growth was actually slower than the market. Not by a lot, but by a bit. And part of the reason for that is we've started seeing these two-tier royalties, artist-centric, whatever you want to call it. And that has been, we've seen the signs now of that really hitting the artist direct. But on a volume basis, the amount of self-releasing artists grew dramatically in 2024. It's up to 8.2 million artists are self-releasing via platforms now. And you think about that, so what that means is more artists are making on average less money. That is only going to get worse. Artist-centric, etc., becomes more widespread. And obviously, Tatiana's a friend of the podcast, and you know that the work that she and I have done on bifurcation, this is going to be one of those drivers that is going to push more and more of those artists to eventually go, I want to find somewhere else, because this is not somewhere where I'm getting a return on the investment. If it was just about money, it probably wouldn't be as big a deal as it is. It's not just about money, because all the artists are getting told, you need to be releasing music all the time in order to make sure the algorithm doesn't forget you. And you need to be doing huge amounts of work on social media in order to make sure that the audiences go. So you put in a lot of effort for very little return. So I think there is going to be a reckoning that will come where a newer generation of self-releasing artists will increasingly look elsewhere. SoundCloud just this week announced the launch of a creator marketplace. They've done partnerships with a bunch of AI music companies. SoundCloud is just doing so much that could well set itself up to be the place where a lot of these artists focus more and more of their efforts. So that's the artist direct. On the label side, it's more straightforward.
Before we get to that, I want to ask you a question about the artist direct piece of it. So you said 8.2 million. I'm curious, how did that look compared to the pandemic days? And I know as a podcaster, I saw that the amount of people that were starting podcasts in the first couple of years of the pandemic was a lot higher than what we currently see. Yeah. Was the same true in music?
Yeah, so there's no doubt we do a lot of work in the music creator tools space with hardware and software and sounds, etc. The pandemic was this massive boom period. Loads of people ended up making a lot more music. There's a real rise of what we call the passionate enthusiast. That's the person who knows that they're never really going to make a career in music. They won't say no if success suddenly comes knocking on the door, but they're doing it because they're passionate about it. They've got a decent paying day job and they can afford to buy some good kit to make some music, and they can get it up onto streaming services. A couple of our clients call it, what is the techno dentist, fixing teeth during the week and then down at the weekend, a tight vest and out with his synth on Sunday night. Or the blues attorney, everybody knows a blues attorney, call into the Zoom call with a stack of guitars on the wall behind him. So that was a really big boost to the creator economy, and that was reflected in the artist direct. And yes, 2 years after the pandemic, that really started to slow. But the artist direct has continued to grow pretty strongly throughout all the periods. So the thing that slowed a bit was the people who were making music but not releasing it. and the people who are releasing music but not releasing it onto streaming but other places. 2024, both of those things picked up again. So even though it's the time where it's become most difficult to monetize, the time where streaming had essentially put up a big sign on its door saying, long tail, you're not welcome here, more people than ever now want to make music.
It's fascinating. I feel like it's like a consumer behavior study. Let's hear about the non-major label side.
Yeah, so the non-major labels, in the report we put out, it's market share that's based on what we call distribution basis. So what that means is you look at the major label revenues, put those in, look at the independent label revenues, you put those in, artist rep, you add it all up, you've got the market. But of course the major labels do a lot of distribution of indie labels. So you've got a lot of indie revenue that is essentially captured within the majors. So the indies grew faster than the majors, even though the majors were distributing a bunch of them. Now, what we do every couple of years, because it's just a ginormous piece of work, but every couple of years we do market share on a ownership basis. So that means if you're an indie label distributing via the Orchard, in the standard measure, you appear in Sony's numbers. On a distribution basis, we strip those out, and we got revenues of about 7,500 different record labels. When we added it all up, we managed to get the recorded music market, the entire global recorded music market, at company level revenue for 94.5% of the market. And there's this ridiculous long tail of tiny little labels, which are 10 or 20,000. In the US alone, there were 75 or 80 labels that had the word big in them. There was this sort of real lack of imagination in people's naming of labels, whatever else. But we did it all. And what you find when you do it that way is that there's basically an extra 7 or 8 points of market share that goes to the independents. So I'm saying all this because, yes, the independents grew faster than the labels and they gained a bit of market share, but it's only telling you half the story. When you go and look at it on an ownership basis, then it's even more growth for the non-major labels. Last thing I'll just say is, I know it sounds really bland talking about them as non-majors rather than independents, but when you think about a label like Avex in Japan, or Hybe in South Korea, they wouldn't call themselves indies. They're majors in their markets. They just don't happen to be one of 3 companies in the West who we call the majors.
Right. Once you're talking about billion-dollar companies, I'm curious, though, is there a threshold that you have to separate what is a non-major label compared to something that may call itself a label, but it's still technically a artist direct upload? Yeah,
we thought about do we create a segmentation between non-major and indie labels? And we found it doesn't really work, because it's like if you're trying to reflect the ethos of what the company's about, look at Beggars. They're approaching something like $100 million of revenue. So in a classification, they would be non-major, big label or whatever else, but the ethos of that label is indie all the way. That's why we've literally just grouped them all together. But the thing that was really interesting when we did the work was dozens and dozens of labels in this like the $25 to $100 million range. You've got in Japan, some of the games companies have labels just for monetizing the music from the games. If they were a label in the US or the UK, they'd be one of the indie powerhouses. You've got labels in China and Armenia and Egypt who hardly figure in the Western radar, but are really big, sizable labels.
And I have to imagine that trend is only going to continue, especially with globalization and all of the other aspects that happen. We're already seeing that play out.
Yeah, if I were setting up a label in India now, I wouldn't just be thinking about how big is my roster going to be here. I'd be thinking about there's this vast diaspora across the world who could be the launching pad for getting my music heard elsewhere, because as we know, that's how global hits are made. You get success, it fires at the algorithms, that fires at more algorithms, and you get that ripple effect. So if you've got enough listeners in Delhi to go and push you onto the global 100 and beyond, I would be thinking, as I say, if I were setting up a label in Nigeria or India or Thailand or Indonesia, I'd be thinking the world is my target market, not my home territory.
One question I do have, there's a lot more focus on the recorded music side of the business, not as much on the publishing. Partially it's because of the size, but is there a reason that you don't also have a publishing breakdown in a similar kind of way?
just wait a few months and it'll be on its way. Now, we do put out the publishing numbers every year. We just stagger it. So we do the label bit first and then we do the publishing bit after. Similar sort of job as we did with the big independent label work. There's just a lot of grunt work going in and getting company level detail because publishing is much more fragmented than on the label side. The majors have a smaller share of the market. But we routinely track the big publishers, and that we've got so far looking at 24 is the big publishers, so that's the majors and a bunch of others, they grew their revenue by about 10% in 24. You compare that to 6.5% for the label side of the equation. So they're still growing faster than the labels. And on streaming, I'm not going to butcher the number by getting it wrong, but it was a lot bigger than the label streaming growth. And if you were to put podium finishes for who did best in streaming growth in 24, it's labels, then it's publishers and DSPs. So the publishers are doing better than labels at getting their share of streaming revenue, but the DSPs are still winning that fight. But if I were to very quickly just comment on the state of where music publishing is now, and it's a ridiculously complex side of the business in a lot of ways when you factor in all the CMOs and everything else. I think what will be really interesting fast forwarding maybe as little as 3 to 5 years in the future is with all of these funds that are in acquiring catalogues, then even if their reason for being in the business is different than a music publisher, they are fundamentally music publishers. So at what stage do they start becoming really significant constituents, starting to be the ones who shape the lobbying efforts? So whatever the next Music Modernisation Act is might be shaped by music funds as much as it is shaped by publishers and labels. What does that do for CMOs? What happens if a private equity company buys a CMO and also has catalogue acquisition, and let's say they go and buy a SoundCloud or someone else as well, and you start thinking about how all those things can be joined together. So I think in some ways publishing is it's a wild card because it looks so interesting to institutional investors, and institutional investors are willing to roll the dice in a way that traditional rights holders maybe aren't.
This is a great point that I haven't heard many other people talk about, predicting BlackRock or one of these companies to be dictating the terms for what the future of publishing may look like.
Yeah, and remember, one of the drivers of the gold rush it wasn't just the fact that there were lower interest rates, it was because of all these CRB rulings and the backdated payments. So that meant if you go before the ruling was finally through its challenges, if you went and bought a catalogue, you were banking on there being X% more value from the backdated CRB rate settings. So if anything, the funds are probably going to be more aggressive at getting better rates and more aggressive at getting the legislation that works to favour the value of publishing copyrights.
All right, we'll definitely have to stay tuned. You may have predicted the M&A future of the industry for the next couple of years. But on that note, before we let you go, I know how much work you put into each of these reports. I'm sure that even though you have a number of reports between now and then, 2025 is probably already on your mind. We're a quarter of the way into the year. If you had to guess what the big theme or what one of the big takeaways would be from next year's report based on how you expect this year to go, what would you say?
Indie label revolution. And when I say revolution, I'm talking about pitchforks and torches rather than transformation. Because I think what we've already started to see with the Amazon version of the artist-centric deal is a lot of indie labels are beginning to realise, hang on, really significant portions of our catalogue are going to become demonetised. And that is literally the right term to use. They will be demonetised because they will still be generating revenue in the platforms. They will just not be earning from it. I'm a big dance music head, and if you look at the way that dance music indie labels work, there's a huge number of them who put out a huge amount of releases, and the half-life of dance music release is really quite short. So you might get your 2, 3, 4 months where you're comfortably over 1,000 streams, but then after that, tracks easily dip below 1,000 streams. But your model was, I just keep signing and releasing 20, 30 tracks a month. So I will be able to, as every month goes by, my catalogue of income gets bigger and bigger because I've got this big roster of fairly slow performing tracks. Well, suddenly in this model, that doesn't work anymore. You spent all this time building this catalogue and a lot of it is no longer going to generate revenue. We didn't see this massive uprising, sea of discontent from independent artists largely because a lot of them earn little to nothing anyway. A lot of them might not even have passed their earning thresholds with the distributor. And to be frank, they're not as educated about the business. So many of them are enthusiasts, etc., or just learning the way. But somebody's running a record label, know how royalties work, they know how the business works, and they know exactly what the implications of a two-tier royalty system mean. So I think we will see this year a huge amount of discontent from independent labels. It's obviously too quick for there to be this bifurcated new indie only lane in the music business by the end of 25, but I think we will see the foundations.
We'll definitely have to follow up on that one. Mark, this was great. Appreciate you coming on. And for anyone that hasn't checked out the report yet, where should they go to check it out?
Just go to MIDiaResearch.com, go and check out the blog, and there's plenty on there, including this.
Thanks, Mark. This was fun. Really appreciate
Thanks
you
for
coming
having
on. Thanks for watching us on YouTube. For more breakdowns like this on the business of entertainment, media, and technology, make sure you like and subscribe to stay up to the latest on any of the insights that we have on Trapital, and make sure that you tell a friend about it as well. That helps continue to make sure that our show reaches the right people. Thanks again. Talk to you next time.